Welcome back to the 12 Charts of Christmas. Today I'm going to take a look at the bear case for US equities. And again, it's not a difficult case to make. First of all, take a look at that blue line. That is the S&P 500 profit margin. Over history, it has had a tendency to be extremely mean reverting. Once it gets up to a peak, then the strength of the negotiating position of workers and so on strengthens, and it comes right back down towards the mean and eventually below it. It's quite remarkable that profit margins have managed to stay so stable for so long. It's very hard to see how they can do that once rates begin to rise, once the economy really begins to grow and earnings begin to rise. So that's one big part of the bear case, that profit margin will finally begin to correct. Next, that red line there shows you labour force participation. People get very excited by the apparent strength of the US employment market, but what we see here is that the participation in the labour force, the proportion of Americans making themselves available for work, continues to fall. Maybe some slight signs of a pickup recently, but broadly speaking, this is still nowhere near as strong a labour market as it looks. If you don't see that begin to improve, it will become ever clearer that the US economy is not as strong as it looks. That, I think, is the bear case, that ultimately we have to be ready, particularly if the Fed starts to raise rates, to see corporate performance correct very dramatically. Next, we'll take a look at the bond market.